Have you ever noticed how your streaming subscriptions, your grocery bills, or even commercial leases just seem to keep going up,
Mm-hmm.
and they never, ever come back down? I
Yeah.
mean, you go to the petrol station, and the prices are just sharply elevated.
Yeah, it's a completely universal frustration.
Right. And you hear on the financial news that there's a global supply chain bottleneck
Mm.
or an oil shock, which logically explains the spike in the moment.
Exactly. The immediate cause makes sense.
But then a year later, the indicators say the crisis is over, supply chains are fully normalized, and yet your baseline costs are exactly the same or somehow even higher. So welcome to today's Deep Dive. I'm your host, and we are unpacking a truly fascinating set of notes and research from a piece called The Upward Baseline: Why Prices Never Return to Normal.
And I'm thrilled to be here to break this down. It's an essential read for anyone trying to understand modern market dynamics.
It really is. Now, before we jump in, I want to establish a quick ground rule for you, the listener. The source material we are examining today delves into topics that frequently become uh, highly politicized, things like corporate pricing strategies, wage negotiations, and central bank inflation targets.
Right. It gets heated very quickly.
Exactly.
Yeah.
So, to be completely clear, our goal today is not to endorse a specific political viewpoint or take sides on the morality of these economic mechanisms.
We aren't here to point fingers.
No, we are strictly here to impartially convey the ideas and structural mechanics outlined in the original research. We want to look past the immediate emotional reactions like blaming corporate greed or political corruption and simply map out the actual machinery keeping the pricing floor so high.
That analytical distance is crucial here. Look, it is entirely natural to feel frustrated when reviewing your quarterly expenses or your personal budgets. We all feel it.
Oh, absolutely.
But the paradigm shift this research asks us to make requires viewing the global economy not as a pendulum that swings back and forth between high and low prices. Instead, you have to look at it as a ratchet.
A ratchet.
Yes, a mechanical ratchet that clicks forward, locks into place, and is fundamentally designed not to reverse. Once you understand the mechanics of that ratchet, you realize that elevated prices aren't a sign of a broken system.
Right.
They are a sign of a system behaving precisely as it was engineered to.
Okay, let's unpack this. Because right away, that ratchet analogy really challenges the dominant narrative we see in financial media. We are constantly told that specific price hikes are transitory.
Transitory, yes.
Yeah.
The favorite word of central bankers.
Right. A war disrupts grain shipments, a pandemic alters consumer demand, or a major canal gets blocked. Those are real, verifiable events.
Mm-hmm.
But the central mystery our source material highlights is, when the underlying temporary shock completely resolves, why doesn't the corresponding price premium dissolve with it?
The answer lies in a well-documented economic phenomenon known as stickiness.
Stickiness.
Yeah. Prices, wages, and operating costs do not exist in a vacuum. When a price surges due to a temporary shock, it quickly gets embedded into a massive, interconnected web of secondary costs.
So it spreads out.
Exactly. Reversing that price isn't just a matter of a supplier updating a spreadsheet. Lowering prices after a shock has been absorbed creates an entirely new set of deeply complex, often insurmountable logistical and contractual problems.
Well, let me play devil's advocate for a second, because the text uses a global fuel shock as its primary example.
It's a great example to walk through.
Right. So if the spot price of fuel spikes, shipping costs go up. We all get that.
Mm.
But if oil drops 30% a year later, why wouldn't a disruptive logistics competitor just swoop in, slash their freight rates to match the new, cheaper fuel costs, and steal market share from everyone else?
It's a brilliant question, but it overlooks the reality of how corporate cost structures are actually negotiated. Let's trace the chain reaction the source outlines. When fuel gets expensive, transportation costs rise. But businesses don't just pay spot prices day by day. To manage risk, they lock in long-term agreements.
Ugh.
They sign legally binding multi-year contracts with suppliers and logistics networks based on those elevated costs.
So they are hedging against it going even higher.
Exactly. So by the time the raw price of fuel drops a year later, those secondary companies are still locked into expensive operational contracts that don't expire for another 2 or 3 years.
So the elevated cost is already legally cemented into the middle layers of the supply chain?
Precisely. And it doesn't stop with supplier contracts. The fourth step in this chain is perhaps the most rigid of all the labor market.
Right, the human element.
When the cost of transport and consumer goods rises, the workforce experiences a real-term reduction in their standard of living. This triggers aggressive wage renegotiations. Cost of living adjustments get baked into union contracts, minimum wages are increased, and salaried employees demand higher compensation to stay competitive.
Which means the entire baseline for moving, building, and selling goods has been completely redrawn.
That is the ultimate takeaway of the fuel example. By the time the initial disruption passes, the broader economic chain has fully recalibrated around the higher price.
It's absorbed it.
Yes. If a company wanted to lower their end consumer prices back to the pre-shock baseline, they would have to execute widespread wage cuts across their workforce.
Which is practically impossible.
Right. And they would have to breach newly signed supplier agreements and deliberately compress their own profit margins. The research notes quite pointedly that no system, biological or economic, voluntarily shrinks itself. The higher cost structure is locked in.
It's like pouring a concrete foundation. Once the secondary effects set, you can't just ask the structure to turn back into a liquid.
That's a perfect way to visualize it.
And here's where it gets really interesting. Because understanding this ratchet effect completely shifts how we view the very concept of inflation. I think most people, even those of us who follow the markets closely, tend to conceptualize inflation as an event.
That discrete event, yeah.
Like a storm that rolls in, causes some localized damage, and then rolls out. But our source text is incredibly emphatic on this point. Inflation is a direction, not a temporary weather pattern.
It is the underlying current of the entire modern macroeconomic system. And grasping that is a significant mental hurdle for a lot of people.
For sure.
Modern economies are structurally designed from the ground up for perpetual nominal expansion. We all know that central banks generally target a 2% annual inflation rate.
Right.
They do not want zero inflation, and they view negative inflation as an existential threat.
And the source material frames this 2% target not just as a safe buffer zone, but as a structural necessity to prevent the system from collapsing inward.
Yes.
Let's look at the systemic risk of falling prices deflation. Rather than looking at it just from the perspective of a consumer waiting to buy a cheaper refrigerator, how does the text explain the institutional terror surrounding deflation?
The text outlines a catastrophic chain of events triggered by a deflationary environment, specifically focusing on capital expenditure and corporate liquidity.
Okay, walk us through that.
If the market expects prices to be lower next year, the rational move for both consumers and corporations is to hoard cash and defer investment.
Because why buy now if it's cheaper later?
Exactly. Why build a new manufacturing plant today if the materials and labor will be 10% cheaper next year, and the goods that plant produces will sell for less?
So corporate investment effectively freezes.
It paralyzes the velocity of money. When major capital expenditures are delayed, business-to-business revenue drops precipitously.
Right.
To maintain solvency, those companies must slash operating costs, which invariably means mass layoffs. The resulting surge in unemployment collapses aggregate consumer demand, which forces prices even lower, triggering further deferred investment and more layoffs.
It's a vicious...
It is a compounding downward spiral that strips central banks of their primary tools, as they cannot easily lower interest rates below zero to stimulate lending. That systemic paralysis is exactly why central banks and governments will utilize every monetary lever available to ensure prices keep moving upward.
That structural fear makes total sense.
Yeah.
And it connects directly to the labor market stickiness we touched on earlier. If prices go up, wages eventually follow, even if the adjustment is lagging and requires friction like strikes or difficult negotiations. But the ratchet only clicks one way.
Consider the alternative the text poses. If prices were to fall sharply across the board in a prolonged deflationary period, the corresponding economic logic dictates that nominal wages should fall as well.
Sure, mathematically that checks out.
But from a purely practical standpoint, downward nominal wage rigidity is one of the strongest forces in economics.
Oh, definitely. Nobody is going back to their employees and saying, good news, groceries are cheaper, so we are cutting your salaries by 15%.
Exactly. The text highlights that no democratic government can survive a policy of deliberately shrinking citizens' paychecks, and no corporation wants to trigger the catastrophic collapse in productivity and morale that accompanies company-wide pay cuts.
It would be chaos.
Because wages fiercely resist moving downward, the cost of production remains high, which inherently prevents the final price of goods from falling. The system stabilizes at the new, higher baseline.
Let's pivot slightly and look at this strictly through the lens of corporate strategy, taking macroeconomic theory out of the equation for a moment.
Okay.
The source material spends a lot of time on price sensitivity testing. If a company raises the price of a critical software subscription by 20% and their user base complains loudly on social media but ultimately retains their licenses, what signal is actually being processed in the boardroom?
The only signal that matters, market validation. The research emphasizes that modern corporate pricing is highly algorithmic and deeply empirical.
They're just testing the waters.
Companies are continuously testing price elasticity. They push the boundary to find the exact breaking point where demand destruction outweighs the increased revenue per user.
Right.
If they raise the price and churn rates remain within acceptable algorithmic models, the market has demonstrated its capacity to absorb the cost. At that point, the new price is permanently cemented.
Because what incentive is there to revert? If I'm a CEO and I see that my customers will pay the higher rate, lowering it, just to be fair, based on past historical pricing, seems like a dereliction of duty.
From a corporate governance standpoint, it absolutely is. Reverting a price that the market has already digested serves no strategic purpose. It needlessly compresses profit margins, signals operational weakness to competitors, and severely damages investor confidence.
They have a fiduciary duty.
Publicly traded companies are legally and structurally bound to maximize shareholder value. They do not optimize for a consumer's nostalgia regarding what a service used to cost 5 years ago.
If we connect this to the bigger picture, the source material identifies a massive foundational engine driving this entire upward trajectory. And that engine is the global debt structure.
This is perhaps the most critical insight in the entire analysis. The modern global economy is profoundly leveraged. We are looking at unprecedented levels of sovereign debt, massive corporate bond markets used to fund acquisitions and operations, and staggering amounts of consumer debt tied up in mortgages and credit lines.
And the fundamental math of debt requires future growth. You borrow capital today under the strict assumption that you will generate more nominal revenue tomorrow to service those liabilities.
Exactly. And how does a corporation or a government generate expanding nominal revenue? They must either dramatically increase the sheer volume of goods and services sold, or they must increase the price of those goods and services. Often, it requires both.
So if we experience a sustained drop in prices, if that deflationary spiral takes hold, the real burden of all that accumulated debt skyrockets?
That is the core systemic vulnerability. If nominal revenues fall because prices drop, the fixed cost of servicing existing debt suddenly consumes a much larger percentage of revenue.
Which leads to a crash.
This leads to credit downgrades, widespread corporate defaults, and sovereign debt crises. The research synthesizes this beautifully. The economic system doesn't enforce an upward pricing baseline because it is inherently malicious toward consumers. It enforces an upward baseline because it desperately requires forward momentum to prevent the entire debt-leveraged machine from seizing up.
That is a staggering reframing. It's not just about greed. It's about mathematical survival for a highly leveraged system. Now, we do need to address the one major caveat the research brings up, because I know anyone listening who works in specific sectors is already formulating this counter-argument in their head.
The tech question.
Yes, what about technology? We all know that a massive high-definition television costs a fraction of what a heavy, low-resolution TV cost 2 decades ago. How does the upward baseline account for tech?
The source material explicitly carves out the technology sector as a unique environment governed by aggressive productivity scaling. In industries where Moore's law or similar exponential leaps in manufacturing efficiency apply, the sheer capability of production outpaces inflation.
Right.
Massive investments in automation and supply chain optimization actually force the unit cost of computing power or display technology downward.
But the text also points out a very clever market adaptation even within that deflationary tech environment. Yes, computing power per dollar has plummeted, but the absolute nominal price of the flagship products, the top-tier smartphones, the premium laptops, continues to climb.
This is what economists refer to as hedonic quality adjustment interacting with upward tiering. Even when the base cost of producing a microchip falls, corporations do not simply pass all those savings to the consumer to lower the overall market spend.
Of course not.
Instead, they continually push the boundary of the premium tier. They add advanced camera arrays, titanium casings, or proprietary AI processing, creating a new, more expensive flagship baseline to capture consumer surplus. The fundamental pressure to expand revenue remains constant. It just manifests as forced technological upselling rather than direct price hikes on static goods.
And that ties perfectly into the final element. The source discusses the psychological component of how we as humans process these shifts. The structural mechanics dictate the prices, but our brains determine how we tolerate them. The text breaks down the psychological anchoring effect incredibly well.
It's a fascinating look at cognitive adaptation.
Right. When a baseline shifts for the first time, say, a standard streaming tier jumps from $10 to $14,
Yeah.
the psychological friction is immense. We notice the delta.
Mhm.
We evaluate canceling. But by the time it jumps from $14 to $17 a few years later, our mental anchor has already quietly recalibrated to the $14 mark. The subsequent hikes encounter progressively less cognitive resistance because our baseline of normal is constantly being overwritten.
It's a vital lubricant for the economic ratchet. However, the source is careful to conclude that while psychological anchoring explains consumer compliance, it is secondary to the underlying physics of the market. Shifting baselines in our minds merely mask the structural realities of cost lock-ins, the terror of deflation, and the uncompromising demands of the debt engine.
So what does this all mean? We've covered incredibly dense macroeconomic ground today, and I want to distill these insights directly for you. The objective of analyzing the upward baseline isn't to induce anxiety about inflation or leave you feeling powerless about your operational costs. The objective is to equip you with structural clarity.
Clarity is your best defense. The practical implications derived from this research are quite stark. First, recognizing that the macroeconomic system is structurally engineered to drift upward means understanding that holding significant wealth and uninvested cash over long horizons is a guaranteed loss of purchasing power.
Right. It just slowly melts away.
Second, delaying strategic investments or major purchases under the assumption that prices will eventually revert to the mean is a flawed strategy.
The mean itself is moving. The system doesn't hit a reset button when a crisis ends. It uses the crisis to build a new floor. Every supply chain shock, every energy crisis, and every labor renegotiation acts as a permanent layer of sediment in the economic bedrock.
Ultimately, the source text demands that we accept the directional nature of modern economies. They expand, they compound, they lock in their adjustments through rigid contracts and sticky wages, and they actively utilize monetary policy to avoid contraction. Recognizing that this upward momentum is required to service global debt allows you to navigate the market rationally.
It changes the fundamental questions you ask as an investor or a consumer. You can stop looking at a spreadsheet and asking, why hasn't this gone back down yet?
Yeah.
That is a backward-looking question based on a flawed premise.
Right.
The only relevant question is, what mechanisms are driving the system toward its next upward tier?
Exactly. When you understand the architecture of the ratchet, you stop waiting for the pendulum to swing back, and you start planning for the next click forward.
I want to thank you for joining us on this deep dive. Navigating the actual mechanics beneath the headlines is exactly what we aim to do here. But before we sign off, I want to leave you with one final provocative thought to consider on your own. It builds on the mechanics we've just uncovered, but scales it up to a planetary level. If our entire global economic architecture, from corporate contracts to sovereign debt, is structurally locked into a state of perpetual nominal expansion and endless mandatory growth just to prevent collapse, what happens when that infinite growth model firmly collides with the finite physical resources and ecological limits of our planet? Can an artificial upward baseline truly outpace physical reality forever? Something to think about. Until next time.